Section 4:2 Risk Management and Portfolio Construction. 4.2 Portfolio Rebalancing and Monitoring. Establishing a disciplined approach to portfolio rebalancing and monitoring is crucial for maintaining a well-aligned investment strategy. Here are some key steps to follow. Set target asset allocation. Determine your target asset allocation based on your investment goals, risk tolerance, and time horizon. This includes defining the desired allocation percentages for different sectors, asset classes, or investment strategies within your portfolio. Determine rebalancing thresholds. Establish specific thresholds or tolerance bands for each sector or asset class in your portfolio. These thresholds represent the maximum deviation you are willing to accept from your target allocation before triggering a rebalancing action. For example, you might decide to rebalance if a sector allocation deviates more than 5% from the target allocation. Regularly monitor portfolio performance. Monitor the performance of your portfolio and its individual components, such as sectors or asset classes, on an ongoing basis. Keep track of how each sector is performing relative to its target allocation and market conditions. Review portfolio at predefined intervals. Schedule regular intervals, such as quarterly or annually, to review your portfolio's performance and assess whether it aligns with your target allocation. During these reviews, evaluate the deviations from the target allocation and the potential need for rebalancing. Determine rebalancing actions. If the actual allocation of a sector or asset class deviates beyond the predetermined threshold, it triggers a rebalancing action. Decide whether to buy or sell positions to bring the allocation back to the target level. Selling overweight sectors and buying underweight sectors is a common rebalancing approach, but it depends on your investment strategy and market outlook. Execute rebalancing transactions. Implement the determined rebalancing actions by executing the necessary buy or sell orders. Consider factors such as transaction costs, tax implications, and liquidity when executing these transactions. Document and track rebalancing activities. Keep a record of the rebalancing activities you perform, including the dates, specific transactions, and reasons for the adjustments made. This documentation helps maintain a clear audit trail and facilitates performance analysis and future decision-making. Stay mindful of transaction costs. While rebalancing is essential, be mindful of transaction costs associated with buying and selling securities. Evaluate the impact of transaction costs on your overall returns and aim to minimize unnecessary costs. Consider using low-cost investment vehicles, such as index funds or exchange-traded funds, ETFs, to reduce transaction costs. Review and adjust target allocation. Periodically reassess your target allocation to ensure it remains aligned with your investment goals and evolving market conditions. Adjustments may be necessary based on changes in your risk appetite, time horizon, or economic outlook. Stay disciplined and avoid emotional decision-making. Maintain discipline in following your rebalancing and monitoring strategy, even during periods of market volatility or emotional market reactions. Avoid making impulsive decisions based on short-term market movements. Stick to your predefined rebalancing thresholds and long-term investment strategy. By establishing a disciplined approach to portfolio rebalancing and monitoring, you can maintain a well-diversified and risk-managed portfolio that aligns with your investment objectives over the long term. Regular monitoring and adjustments ensure that your portfolio remains on track and reflects your desired asset allocation. Setting guidelines for adjusting sector weights based on performance and market conditions helps provide a systematic framework for decision-making. Here are some guidelines to consider. Define target sector weights. Start by establishing your desired target sector weights based on your investment strategy, risk tolerance, and market outlook. These weights represent the ideal allocation of your portfolio to different sectors. Determine performance thresholds. Set performance thresholds that trigger adjustments to sector weights. These thresholds can be based on absolute performance, example, if a sector has gained or lost a certain percentage, or relative performance, example, if a sector is outperforming or underperforming a benchmark index or other sectors. Establish thresholds that are appropriate for your investment goals and risk appetite. Monitor sector performance. Regularly track the performance of each sector in your portfolio. Monitor factors such as price movements, earnings reports, economic indicators, and industry trends to evaluate sector performance. Use reliable data sources and analytical tools to gather information and assess the relative strength or weakness of each sector. evaluate relative performance. Compare the performance of each sector against relevant benchmarks or indices. This helps you determine whether a sector is outperforming or underperforming the broader market or its peers. Consider both short-term and long-term performance trends to identify consistent patterns and assess the sustainability of performance. Review market conditions. Assess the prevailing market conditions and macroeconomic factors that can impact sector performance. Monitor factors such as interest rates, inflation, GDP growth, geopolitical events, and industry-specific trends. Evaluate how these factors may influence the prospects of different sectors. Establish adjustments guidelines. Define guidelines for adjusting sector weights based on performance and market conditions. For example, if a sector exceeds a predefined performance threshold, example outperforms by a certain percentage, consider increasing its weight in the portfolio. If a sector falls below a predefined performance threshold, example underperforms by a certain percentage, consider reducing its weight in the portfolio. If market or economic conditions change significantly, reassess the weightings of sectors that are particularly sensitive to those conditions. Implement adjustments. When a sector meets the criteria for adjustment based on your guidelines, initiate the necessary trades to increase or decrease its weight in the portfolio. This may involve buying or selling securities or adjusting positions through exchange-traded funds, ETFs, or sector-specific funds. Regularly review and reassess. Continuously monitor and review the performance and market conditions of each sector. Regularly reassess your sector weightings and adjust your guidelines if necessary. Market dynamics and sector performance can change over time, so it's important to stay agile and adapt your approach as needed. Remember, these guidelines are meant to provide a framework for decision-making, but they should be tailored to your specific investment objectives and risk tolerance. Regularly evaluate the effectiveness of your guidelines and make adjustments as necessary to align with your investment strategy and market conditions.